Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote.
Hello, everybody. Welcome to another edition of the Value Guys Stock Talk Show with the Value Guys. I'm Val Hughes.
And I'm Momentum.
And we are 31-year Wall Street veterans who have had to take on secret identities and go underground in order to provide you with a handful of great value ideas each week that come out of the screens we do here in the shop. You've seen our faces on TV, you've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices, and they'll never know. This week, it's the week of June 5th, 2012, and I know that starts on a Tuesday, but that's just what we're doing. And we've done a very special screen this week by request of a listener, Kevin, and I won't say your last name, sent in the idea that since we're doing some screens, why not do a magic screen? So we're doing that this week. But before we get into that, a couple of important caveats. First, this show's for entertainment purposes only. It's not a guarantee. Secondly, this is after hours, just a hobby for Mo and I, so while we are professional analysts during the week, doing extensive fundamental research, talking to management teams, their competitors, we leave no stone unturned during the week. Here we've done absolutely none of that. Third, our lawyers tell us that we should remind you that we do not have your best interests in mind, and we may be recommending, accidentally I assure you, that you do the opposite of what we recommend. Or something like that. So do your own work. And finally, we've been drinking a little bit here on the show. So I don't know.
How appropriate.
Yeah.
Alias.
Yeah, we do have a nice
Cabernet.
one. I may just put a picture of this up on the site because I've never seen
Alias.
this.
How perfect for our aliases.
So with that, we've got a couple more important caveats at www.thevalueguys.com, where you'll also see links to past shows. There's 5 years of shows indexed by ticker. There's a best ideas list that I update every so often, And then I recently put some interesting data on there. So there's some historical U.S. statistics back to prehistoric times. I think you put a tablet or two up there.
We've got ours, yep.
And a couple of other goodies there. So www.thevalueguys.com. Now, for you you listeners that are new to the show, you might want to just turn it off now, save yourself the trouble. But if you're still listening in, Mo and I like to give 3 good value ideas each week, so that's what you're going to get. And they might not all be good, but we do our best. And then lately, due to listener requests, we've got some really interesting segments to the show as well. Paging through national economic trends, which recently the president called. He really enjoys listening to that.
Right.
Evidently, that's where he gets his economic news, so I'm happy to provide that. And then, this week we've got...
We're doing a segment entirely in Italian.
And that's toward the end of the show.
Right, so it's a...
Stay tuned for that.
Yeah.
Mi amore.
Yeah.
Right? And also, and Mo doesn't know this, so I'm just announcing it here for the first time. We're starting a new segment right now, and Mo is in charge of it. And it's called Value Guy Current Events. So,
Value Guy. I can do that.
I don't know. Can you do it?
A lot of news. Did you see today? Goldman Sachs in the news.
Were they?
They're letting 500 bankers and managing directors go this week.
Go where? On vacation?
Go away. This week they're gone.
Okay.
And
wow. Ouch.
They're calling it the post-Faceplant era.
Post-Faceplant.
Plant. After a 30% decline in Facebook, now named Faceplant.
Faceplant.
The IPO market's frozen. So they're letting bankers go. Now here's the math.
Where are they going?
This is what's great. They're just being fired.
Oh.
Goldman says it's going to add 3 cents a share to EPS. So you work backwards based on the shares outstanding. These guys were making $15 million each.
Really?
Really?
That's got to be top 1%, right?
I don't know. Well, no, not top 1%,
Top
but it's up there.
Top quarter 1%.
Probably top 10%.
Top 10%. At least.
Yeah.
At least.
Yeah.
Yeah.
So that
Wow,
was
do
in
you
the
know any
news,
of
yeah.
these guys?
No,
I mean,
but
are they sad or
we should
happy?
start pitching them with the wealth management part of the business.
Well, we do have some important brochures. Maybe we can send them about. It's got like the Value Guys URL on it.
Yep.
And our last couple show links. I mean,
Yep.
they're going to have a lot of time on their hands. That's
so,
crazy.
Yep, we should do that. What else?
Well, thank you,
Gold,
Facebook.
gold.
No, you're really taking this segment by the
I'm telling you
by the
something.
balls here a little bit.
Something's up with gold.
Really?
Yeah.
Okay. What?
Well,
It's down a lot, I know.
Well, I think it's ready to take off. Last week, I go in,
Yeah.
I get my teeth cleaned.
Yeah.
My dentist comes in. You know what
He's
they're
selling you gold. He's peddling you gold.
You know what they're doing?
No, I do not. This is all news to me.
They will take out the gold fillings in every one of the teeth where I have a gold filling, and they will replace it with the titanium impregnated porcelain state-of-the-art tooth, which is implanted. It'll last for the rest of your life. They will do that just if I give them the gold in my teeth.
Give them the gold in your teeth.
And they'll
You're
do
not
the-
going to do that.
They'll
are you,
do the
Mo?
work for free.
Really?
Yeah.
Are
So-
you going to do that? So what? How can we win on that? Is that
Well, what does that
you
tell
buy
you
a
about?
stock?
You think maybe gold is going to go up, and
I'm thinking Patterson Dental, PDCO. That's what comes to mind.
maybe, but I think you just go right for the gold. My wife wants to strip the gold leaf off of the paintings in
No
the living
way.
room. She says that we can melt it down,
Watercolor
and
it
she
in?
can redecorate the house. Something's up here. I noticed.
That seems bubbly,
and
don't
I
you
noticed
think?
that parking lot attendant
Yeah.
eyeing those gold-plated hubcaps of yours on your
Yeah.
Lexus.
Yeah. No,
So,
that's not my car.
These are the
That's my
kind of
partner's
these
car.
are the global sort of indicators that we use when you want to see a move in a commodity. You know something's up.
You go to the dentist and see what happens.
So
Well,
that's my
fascinating.
prediction. Gold's going to go up.
All right. Well,
Stocks.
let's get to the stocks then.
Right.
Mo, let's
That's
get
what-
right into it. You
that's
know,
what
this
the-
week we did a thing called a magic screen. Now, here's the thing. This is surprising to me. I've been in the business a long time. We do some screens. We do, and one of the things you think about when you're buying anything is what am I getting and how much am I paying, right? Supermarket, department store, airport. It's always what am I getting? What am I paying? Okay.
Right.
So I've always thought in terms of what am I getting as the return I'm getting. What distinguishes companies' bottom line? The return on the money you invested, capital, return on capital. And what am I paying? My currency is a PE.
Right.
Or a multiple on earnings and something, okay? I've been doing this my whole career. You do different things. You can measure ROE, ROA, a lot of ways to measure returns on capital. But evidently a guy wrote a book, and he called this the magic screen. And so evidently on FactSet now, it's just a button. So, when I got in the business, doing this was someone's job. I mean,
Right.
you want to know why there are fewer people on Wall Street. This whole screen, this used to take one guy a week. And so that was an entry-level analyst position, Now it's a button. So it's called the magic screen. It basically measures, and this is a little bit of if you want to fast forward through this, I'm just going to explain this a little bit for people that have an interest in how value screens work, because this is a pretty basic screen and a good one, and there's no tricks going on here. You don't have to be that smart in finance to understand this. You take your earnings before interest and taxes, so that's the earnings that are earned by the business. You don't want to subtract taxes and interest against measuring how good the business is, because that's a function of what the government's taxing you and what your interest rate is if you have one on the capital. So this is before all that. And then there's something called enterprise value, which we talk about here on the show every day. It's how much would we all have to pay to own the right to all the cash flow. So we got to buy all the stock. That's the share price times the shares outstanding. We have to buy back the debt, otherwise we owe somebody interest, so let's buy that back. But we get to use our cash to pay for some of that, so we net that out. So basically, you take market value of equity plus the debt
Minus cash.
minus cash. And these days, actually, it makes sense to go see what the market value of the debt is, because it can sometimes be very different than the book value. But years ago, it was the same. So that's your enterprise value. if you take your earnings before interest and taxes, or what we call EBIT, divided by that enterprise value, that's a yield. So in this magic screen, all the yields of the 2,000 largest companies were calculated in about 2 seconds while I was opening that wine. So again, not that tedious for me, the user. And so, and then we ranked them 1 through 2,000 on that. Then you look at return on capital. Again, this is so simple. It's just that same earnings number that we just used for the yield. And we basically take working capital. I'm sorry, that's going to be the return. That's the earnings. We use the same earnings in the return calculation. The capital calculation is all, it looks just on the asset side. So we're not going to think about how you're funding this. That's independent of that. You might have a good deal at the bank or you may not. You may use cash out of your pocket, what have you. We're not going to worry about that. So it's just the net property, plant, and equipment that you need to run the business, plus the working capital, which is going to be, and my guess is it doesn't say that, it's probably net working capital. So it's how much we have to put into the inventory, the receivables, any cash we might need to have around to pay for things week to week. And then against that, you're going to net out any short-term payables, so accrued, or things you owe people, basically, your vendors, your employees, and things like that. If you add working capital to net property, you get capital. That earnings number we already talked about divided by that capital is your return on capital. And then you just rank that, 1 to 1,000, 2,000. You average them, and then you simply rank the companies. And you get, we picked the top 100.
And out of 2,000 names, explain this to me. 2 of the top 3 are public for-profit education companies.
Yeah.
ITT, which I think we talked about a week or 2 weeks ago, and Bridgeport Education. So any clue why out of 2,000 names ranked this way, 2 companies in exactly the same industry rank? What do they rank? They rank 1 and 3.
Yeah. Mo, I'm glad you brought that up. This is why you're still going to need people as analysts, and the computer can't take over. The thing about computers is they don't know the future, and they don't read the Washington briefs. They just don't know.
Not yet.
Not yet. That's coming. Thankfully, we live in an age before computers can read and interpret and conclude things faster and better than we do. Well, obviously, it's coming. But in these education guys, what's happened, it's been in the news, I don't know if we have talked about it, but they're under siege a little bit because the students that come out of these programs, and it's exacerbated by a very difficult economy, but when the economy gets bad, people that might have worked, they instead go to school, and then when they get out, they don't have jobs. I mean, it's not hard to imagine.
And the government thinks that the graduation rate is too low.
Too low, and importantly...
I graduated from a school where there was only a 2% employment rate after we graduated.
2% unemployment, right?
2%
employment.
And
that was for the summer, probably.
And the government never said anything.
Yeah.
Those were the days.
That's when college was cheap, though. I mean, if I did the calculation, my last semester tuition at my college, graduate school, now I was an in-state student, it was $700 divided by my starting salary, which I think was $25,000. This is 1980. That ratio today...
Wait a minute.
Yeah.
Wayne was paying you $25,000?
Yeah,
I was making $23,800.
Were you?
You're kidding me.
He told me not to mention that.
Is that a real number? Were you really making?
Yeah, honest to God, that's my number.
No.
Yeah, I was like 100 or 200 a month ahead of you.
Damn.
Yeah. You had a much nicer office, though, Mo.
Did you know that you
Weren't
were making
you on
that?
the Windows
Did you
side?
know you were making that much more than... Was I making more than Maura?
I was... I don't know.
Well, anyway, we'll do this offline later.
No,
Let's go back to the stocks.
No, I don't know.
Forget it.
You were not making the most, though. You barely got hired, Mo. Yeah, you were on the low end. Hate to tell you that. Yeah. It was my recommendation that brought you in. Okay, so here's the thing. These education companies are at risk because the Congress is basically saying, if it's not so much the graduation rates, frankly, I don't think the Congress or the banks care much about that. It's like, whatever. That's Joey Baha.
I know.
Yeah. But I think when they get upset is when the checks don't come in with the payments. And the reason they don't come in is they don't get the jobs. And guess what? Great schools have people that aren't getting jobs. So you can imagine some of these schools Like, what's a history degree from DeVry University going to do? I mean, they don't, the normal jobs that you might get aren't even in demand because of the recession.
Starbucks barista.
Well, they're full up.
Yeah, I guess.
There's nobody needs that. So, in any case, this screen and the weakness in all screens is you're just trying to get an inbox because it's entirely backward looking. The only thing on the screen that's forward looking
is us.
Well, us, thankfully, because we're human, as far as everyone knows. Yeah. But there's a price that's multiplied by shares to get market cap. That's honestly, and if you use market value for debt, you got it as well in terms of a forward-looking view because the market provides that in price. But otherwise, everything is what happened in the past. So these education companies are at risk of having dramatically lower enrollments. It's already happening if you look at their numbers because the government may not be approving the loans for the tuition, and then, of course, revenues go down. So if you look at the breakdown, those two education companies are number 3 and 5 on earnings yield. That's what gets them, let's see, is that right?
Yeah, it is. They're number 3, and they're...
Yeah, because the earnings are historical, and the price is down in anticipation. So that's the trap, and so we passed over those, ladies and gentlemen. And we had to actually look a little bit down the list here to find our first name. And that's just our own views on things.
Right.
Who knows?
What was Amerisource? What was this
Well,
number?
this is called Amerisource Bergen.
And how far down the list was
Ticker ABC. Amerisource Bergen is the 14th best company on earnings yield.
Okay.
But on ROC rank, they're 79th. That's what hurt them. So they came out 25th overall. But here's what I like about it. It's my attention is drawn to the valuation. 6 times EBITDA. I flip that over. 16% cash on cash yield if we bought it. What do? Is it risky? No. It's pharmaceutical distribution, and I don't care how much the internet takes over. You can't email medicine through on the internet. So they are one of the handful of big companies, Cardinal being another one, McKesson being another one, that take all the shipments from all the pharma companies and then send them out to the hospitals and the doctor's offices and all that. And people shy away because they have such skinny margins. For example, 3% gross margin seems low in a world where people usually are used to seeing 25, 30, 40, 50.
Because they're not thinking about a distributor, they're thinking about an actual pharma company.
Well, or a retailer makes a 50% margin, et cetera, on the gross. This has got to think of as a markup. So they bring $1 billion worth of, and I've toured actually some of these facilities. One of the reasons I chose it, Mo, is that I used to do these groups years ago. And these facilities can move $5 billion worth of product, in part because pharma costs a lot, but it's little bottles and little tubes, and they have it all automated. Things move on conveyors. They can tell if an order is correct by weighing it out to the tenth of a gram and that sort of thing, and it automatically goes on the truck that's going on the route to those stores. So they take a teeny markup, and that's what the gross margin is.
Okay,
I'm moving $100 worth of drugs through my store. I'm charging you $3 for that.
Well,
but it might have been 10 pounds of stuff, But
when you look at that, the first thing I noticed was that it did seem low until I realized it's a different company. But look at the margins are interesting because the first 3 years on this table margins were 1.3, 1.3, 1.3. Great. So that they seem flat, but in the last couple of years they've gone 1.4, 1.5, 1.7.
Yeah.
So interesting. The margins are actually expanding now, whether they've plateaued or not. But so that's a fundamental positive.
Well, what happens with these guys is they put a big new distribution center up. It's almost entirely fixed cost. These things run with 2 guys.
Right.
And as they fill it up, their margins go up because their marginal return is 100%. And so one way to think about it is it's a service company. So when you see a gross margin of 3%, and an EBITDA margin of 1.7%, here's how I'd put it to you. Our fee for moving your stuff is 100, right? And we just earned, 7. Well, let's put it this way. I'll make it easier. The stuff we move through your store is worth 100, and I'm sorry, we're going to charge you $3 for moving that stuff, and we make $1.70. So in effect, the margin, what I'm trying to say is the margin on our fee for service is just north of 50%. And
No, fair enough.
I'm trying to, if you put this as a service fee, these are enormous margins. And you see it you don't see it so much on the return on assets line. So here's another thing to think about. You see a 4 or 5% return on assets and you go, well, gee, that's not very good. But what if I don't want any competitors? I price myself low enough, I keep my returns low enough so the pharma companies aren't mad, they're not going to switch.
Right. Or do it in-house or anything like that.
Right, they can't do it in-house. And because my numbers are so stable, I can leverage up a little bit. These guys are 47% debt to capital. The asset to equity number is 5. So that's a true measure of my leverage. I'm earning a 4% return on assets or 5%, which doesn't upset the drug company because that seems low to them. But because of the stability, I can go to the bond market and have pretty good, I don't see the bond rating here, but the numbers are so stable that I can lever that 5 times, and my return on equity is 24%. So that's pretty good. You're paying 6 times EBITDA, and I'm a fan of this. You got the stable growth, et cetera. So.
You got a yield too.
Oh, you do? I didn't even notice that.
1.4 dividend yield. So your degree is in finance, right?
Yes, as far as I know.
I want to do a little test with you.
Please do.
I want to see how well you did in school.
Okay.
I'm going to read you 1, 2, 3, 4, 5, 6. I'm going to read you 7 years of their dividends. Don't look.
I want to look ahead.
I know you can't. I'm going to read you the last 7 years of their dividends.
Is this a timed thing?
And I'm going to ask you to guess next year's dividend. You ready? I'm going to tell you.
All
2006.
Right. I'm not prepared.
Went from 5 cents
to
10.
Yeah.
To 15.
Gotcha.
To 20.
Okay.
To 30.
Wait. 20 to 30? Okay.
20 to 30.
Gotcha.
40.
Okay.
50. What's next year?
Is this the Fibonacci series?
What's next year's dividend?
I'm going to guess 60. Just going to throw it out there.
You're wrong.
What is it, 65?
No, it's 60. I don't know if it's 60. It could be 60.
Oh, we don't know. Okay.
But, so, great trend in dividend. Easy to forecast. We like these kind of companies. And you could the master's work.
Method. Yeah, no,
was very evident in your forecast.
I mean, that's third semester.
You caught that little 5 increment going to 10 like
you gotta
that.
pick that up, you know.
Anyway, so
Okay.
I think you got a nice dividend growth. That's interesting. And who's our next candidate?
Okay, let's see. We've got
Joy.
We've got Joy Global.
Now wait a minute.
Ticker JOY. Joy.
It's a coal company.
No, well, they service the coal industry.
And
so,
their
yeah.
ticker symbol is Joy.
Yeah. Yep.
They should sell the ticker symbol to a sex toy company, book the one-time gain, and do a special dividend
the ticker,
to shareholders.
Just sell off the ticker.
JOY.
Why not? Wait a minute. Why not sell it to Disney?
We could sell it to Disney.
Yeah, that's a more wholesome thought here on the value, guys.
Better idea.
Yeah.
The Catholic Church.
Yes.
They've got money.
Yes.
Well, they got some money left over, but yeah that's what we sell to.
It certainly has a better use.
We
than
buy the
this
ticker
guy.
for ourselves.
Okay.
Warehouse it. Let them choose another ticker. They still book the one-time
Bide
gain.
our time, if you will.
We sit on top of it.
Yeah.
We put feelers out. Who want? Yeah. What do you think we can buy it for?
You've got some guys in the ticker business, don't you?
Yeah, we do have in the ticker business.
Yeah, I mean, they're still holding out M. They keep trying to lure Microsoft over to the NYSE with the M.
Well, anyway,
it's working. So
about
far.
the stock. So
all right, I've lost my train of thought.
You've got the thing is,
it's
a hidden asset.
The ticker.
The ticker is a hidden asset.
Well, it might be worth a couple of $1 million. Throw that in on top of their $7 billion enterprise value. It's a little sprinkle there on the top. So here's the thing about Joy. I'm sorry to say that I've been enjoying the